Hello and welcome to Money, Me and COVID-19, where we meet with leaders from the world of business, financing, investing and politics to find out what's really going on during this pandemic and how we can position ourselves to survive and then hopefully to thrive in the aftermath. Now, if there is anyone in this country with more knowledge of precious metals than my guest today, I've yet to meet them. He's been around the sector since the 1980s. He started in a gold refiner. He then became a bullion dealer for people like Rothschilds and Credit Suisse. And then even in the late 90s, he broke some new ground by launching a real-time information service for the professional metals sector. He then moved on to revive one of the oldest names in gold broking, Sharps Pixley, that dates back to the 1700s, and set up their amazing emporium in St. James, which is well worth a visit if you're in London. And after leaving there last year, he's now actually gone back to his roots as an information provider by launching the real-time platform Metals Daily, which has become the biggest source of information on the planet. I got introduced to him first by the Money Week writer, Dominic Frisby, who said, when it comes to anything to do with precious metals, this guy is my secret weapon. His name is Ross Norman. Ross, welcome to Money and Me.
Thank you, Graham. Yes.
Before we go into any of the sort of specifics around precious metals, can I just at least get your take on the macro level? Because this has been a bizarre year. You know, we've had this incredible involvement from the central banks and governments. What's your take on the kind of way they've reacted to the pandemic, and what does it mean for us as investors?
I don't think I was alone in looking at the chief scientific officer and the prime minister in the early days of the COVID crisis. And I think that they were doing what they felt was the right thing. And I think that they were genuinely deeply concerned. And I was impressed by the scale and speed of the activity on an economic front to backstop industry. I don't think any of us had expected it was going to be a short thing, but it certainly looks like now it might drag on for longer than we'd anticipated. The economic consequences of this will be quite dire. As a statistic, for example, I'm told in North America, there's over 350 job losses for every death that they've incurred so far. It's difficult to equate the one to the other in terms of value, but it gives you a sense of scale. So the word epic is used quite a lot, but it has to be in regard to the recent stimulus that we've seen. I don't think we've seen the end of it. Larger enterprises will be supported by banks, but small to medium enterprises will, I think, have difficulty getting support from government on an ongoing basis, and indeed bankruptcies are rising. So I think gold is responding to a lot of the story. Not COVID directly, but the second order consequences of it, the economic consequences, whether it's through the Treasury, the US dollar, debt, and the general fear that pervades. And no surprise that gold's performing incredibly strongly.
Yeah, but I think many of us were already concerned about the level of sort of money printing and bond buying by the Federal Reserve and what you could argue as market manipulation. But the fact that it's now gone into overdrive, but seemingly without causing a complete financial meltdown, this seems to be lending support to what you could call the modern monetary theorists who think we've got this magic money tree. I mean, where do you think this loose monetary policy is ultimately going to take us?
Well, I think that there was economic difficulties even before COVID was on the scene, and gold reflected that. Again, coming back to gold, we saw a 19% gain last year, well before we had the crisis. There's no doubt in my mind that economically things were difficult already, not just issues in the repo market, but the general levels of debt. The West has been living beyond its means, something between 15 and 20% every year for the best part of a generation. And that can't be sustained without some consequence. And how are we able to do that? Well, not just QE, but also by selling of our treasuries to foreign investors. These IOUs are bought with a possibility of default and a very tiny bit of interest attached to it. But Johnny Foreigner has been very happy to buy this, and by extension, in other words, exporting his surplus savings to the West, which has enabled us to live beyond our means. And that policy, I don't think, was ever sustainable. Some people would say that this has come along at a good time, this COVID crisis, because it enables us to mask what was already a very dark and dangerous emerging economic crisis anyway. The reality is governments behaved as best they can by accelerating QE. The difference this time round, though, back in 2008, we saw it going into the commercial banks, propping up technically insolvent banks, high street banks. This time the money's coming to the people. And by extension, you would expect that when retail spend does start to accelerate, when the economy does start to open, that there should be some prospects of inflation down the line.
Okay, well, I mean, gold is something that loves fear, uncertainty, and doubt, and we've had plenty of that this year. But if you look at a broader context, what do you think are the drivers behind this surge in the gold price that we've seen recently?
Yeah, I think there's no question. I mean, if you go back to end of last year, it was the beginning of negative real rates in the US 10-year Treasury, slipping. As I say, currently it's -1% in real terms. In nominal terms, you're earning 73 basis points. And it was the shift in the US bond market, I think, which shifted interest into gold inexorably. We'd already seen strong buying from the central banks over the last 4 years. A decade ago, there were sellers of 400 to 500 tons. Currently, they're buyers at 400 or 500 tons. A swing of 1,000 tons in a market which only produces 3,500 tons. That's a lot. So central banks are already buying, but the real shift has been in the ETF market, the slow glacial money that comes out of pension funds and the like. And at the 6-month mark, we were already at an annual high in terms of previous year's purchases, over 800, 900 tons. So, again, we were seeing phenomenal buying coming in from the quality end of the market. And I think that was responding to what they were seeing emerging.
Yeah, but I suppose just coming back to the way the banks have responded to this and the governments, it's hard to see. I mean, many people that I respect have been predicting some kind of financial disaster for years, and it's never actually happened. So there's a horrible part of me that thinks, are these guys actually right and I'm wrong? That they can just go on doing this ad infinitum. I mean, what do you see as a potential tipping point where this all collapses?
Well, it doesn't have to, first of all, be a binary, does it fail or does it not? I mean, that's the key point here. You don't throw everything into gold or nothing into gold. And the way you should approach it is say, what are the chances of this getting really rather sticky in the next 3 to 5 years, which is a sensible horizon within which to invest in gold? If it's 1 in 10 chance that, we have a run on the currency or a massive debasement of the US dollar, an extension of the violence in North America. Well, if it's 1 in 10, then that's your allocation to gold, 10%. 1 in 20, 1 in 5 is 20%. So it doesn't have to be a binary thing. And the sensible thing would be to shift more and more into physical gold, the more uncertain you feel, but not to do it on a. I wouldn't respond to news and chase your tail. I think almost like a metronome, every 6 months, take a visual photograph of the world, remember the last photograph and go, how much do I like it compared to last time? A little more, a little less, and then move your position accordingly. Going back to your question, what's the tipping point? Confidence in currencies when they go happen quickly. And I don't think we're there yet. I'm an optimist at heart, and I think we normally find a way out of this mess. But I have colleagues of mine, German colleagues of mine, who have seen collapses in confidence in currencies. An average currency lasts only 30 years, and 3,200 have gone throughout history. So that it does happen. Here in Britain, we've got the world's oldest currency, at 1,200 years old. We have every right to feel a little bit smug, but our currency has fallen in the course of my lifetime. A pound's fallen by over 90% in terms of what it can acquire. So currencies do diminish over time. For a full run on a currency of the sort that you alluded to there, I don't think we're there. It would take an evaporation in confidence of an epic scale. Certainly, it's lower than it used to be. We've moved a mountain of debt onto the central banks, into their responsibility, and they'll be responding this week. As you're probably aware, there is the Jackson Hole meeting going on where central bankers from around the world meet, and the US Federal Reserve are announcing tomorrow what the Fed policy framework will be, particularly in relation to perhaps easing up a little bit on inflation. So we're going to get a view which may backstop some confidence in the official sector.
Okay, well, I think one of the key drivers, obviously, of gold is almost an inverse proportion to confidence in the US dollar, and we're reading more and more now that countries like China and perhaps Russia are trying to find ways of avoiding using the US dollar in international trade. Do you see that as a trend that's going to increase and therefore be good for gold?
Yeah, Nouriel Roubini recently came out to say, and I agree with him, the suggestions of the demise of the US dollar is premature. It still accounts for close to 60% of global trade. That's not to say it couldn't shift, and I don't doubt that China looks on with some dissatisfaction of the strength that it imparts on America to have the world's global reserve currency, and they'll seek to challenge that. I think what could make a difference is the digitization of the renminbi and to gold back it. There was early suggestions that they might gold back it. That was later refuted. It's now not known. And I think that ultimately, if they did gold back it, not 100%, but to a proportion, that would lend it significant credibility. China, you could argue, already owns the economy to a large extent. And America is trying to fight back, pushing back hard. It remains to be seen how that plays out. But at the moment, it's something of a stalemate going on. China's sitting on $3 trillion worth of treasuries in US dollars. It's got to be careful about how it fights that war. It doesn't want those treasuries to be nullified and that value to be lost.
No, it's almost become like the old Cold War nuclear balance, hasn't it? That they both depend on each other in a strange sort of way.
Correct.
Yeah. Now, I think one of the things that encourages me into thinking that we are at the start of something strong for gold is what you touched on earlier on with the kind of people that are now investing in it. And of course, at the top of that list must be the number one gold skeptic of all time, Warren Buffett, who's now put $500 million into gold mining shares.
Yes.
But we've also had some big hedge funds investing as well. So what do you think's made them change their tune now? And have they got the timing right for making this entry into the gold market?
I'm not a mining expert, but typically, historically, you would say that you'd get a leverage on buying mining shares. And going back to Warren Buffett, of course, he likes to put his money into productive assets, buying meaningful assets. And he was very unkind about gold. So there was a certain degree of satisfaction in seeing him invest in Barrick Gold. To a large extent, that leverage that you got in investing in mining shares has been dissipated over the last 15 years, really because institutional investors wishing to access the gold market, it was the only way they could do so was by buying the mining shares. And particularly if you bought a marginal producer, which is only just making profit, if the gold moved higher, then you have an exponential rise in its profitability. So the marginal mines was where they were looking at investing. The reason that they invested in miners rather than the gold itself was simply because they couldn't invest on the London Bullion Market exchange, the London Bullion Market, and with that exchange, the counterparts that were trading it, until we launched the gold ETF. And the gold ETF then forged this massive conduit between the investment community and the bullion market. Physical gold traded on the exchange, and suddenly pension funds had an access to market. So instead of investing in the mining shares, they invested in the ETF. And so by extension, money didn't flow into the miners. Perversely, ironically, if you like, it was the miners themselves who had developed this ETF through the World Gold Council. So in a sense, they shot themselves in the foot because their share price didn't respond to this initiative. But nevertheless, gold has benefited by being more open and by allowing people to buy gold in the form that they want.
Okay, well, since you've touched on that, for those that aren't familiar with the options, can we just quickly look at the pros and cons of, you've got ETFs, you've got allocated gold, you've got physical bullion delivery. What would you say are the kind of pros and cons of those main ways of people getting into the gold market?
Well, it depends upon whether you're a speculator or an investor. And you literally have got a spectrum, as you point out there, from options where you've got literally 1,000-fold gearing. Futures, where your gearing is roughly 12 to 1. Forwards, which are unstructured, if you like, or informal futures. And there, again, the gearing can be variable depending upon who you're dealing with. You have then got ETFs, which are normally traded on a 1-to-1 basis, but you can get a 2-to-1 gearing in ETFs, gold ETFs. And basically you're owning gold through a nominee, physically backed, vaulted, typically at HSBC here in London. So it's a very attractive way of getting exposure to the gold price because the bid-offer spreads are very tight and the costs are very low for the vaulting, etc. And then you've got physical, and then you've got coins and bars within that. If you're a UK investor, you'll be looking at sovereigns and Britannias because they're capital gains tax free. If you're a non-UK taxpayer, you're probably looking at bars, which have a lower premium. There's no VAT on investment gold here in the UK, but there is VAT on the white metals. So silver, platinum, palladium, again, very attractive metals again, but they, in a physical form, attract VAT at 20%, not as an ETF, but as physical, where you take delivery.
Okay, and you don't share the skepticism that I hear from many gold investors about ETFs not having enough underlying metal if everyone wanted to, to sort of take delivery at one time. You don't see any kind of risk there of the ETFs.
No, I don't. No, I don't. The metal is there, and these are some of the biggest ETFs in the world, listed on some of the world's biggest exchanges, and they wouldn't be able. And there's auditing that occurs at every single stage of the process. They wouldn't be able to run positions if they didn't back it. To be clear, the 2-to-1 geared ETF is not backed by physical; it's backed by futures. But the normal physical ETF is backed by physical. I have no doubt that there's physical metal that sits behind those ETFs. Oh. What I find unsatisfactory about most of them, on the other hand, criticism where it's due, is that too many of them make it rather more difficult to redeem them if required. In other words, if you've got a position, a security backed by physical gold, if you say, I'd like to take delivery, it's rather hard to do so. They're not well set up to do that. So for many of them, Xetra in Germany is an exception, but for many of the larger ETFs, it's quite difficult to get the physical in extremis if you need it.
Okay. Now, every guru on the planet seems to have a prediction about the gold price and where it's going from, X thousands of pounds. But somebody with your length of experience, and I think a more measured response, what would you think is a realistic target in what sort of time frame for where we're heading with the gold price?
Well, back in December, go onto the LBMA's website, you'll see the forecast that all of the market makers and other traders within the market give. Back in December, I predicted that gold will hit a high of 2,080. Year to date is hit 2,075. If it doesn't go any higher than that, I should be quite happy. When gold, I think that really to see where we go from here, you probably need to know where inflation is going to be going when it comes. If it holds at the 2 to 3% level, I think that can be sustained. If we go to 3 to 4 to 5%, and Graham, you and I can remember double-digit inflation in the 1970s, then it's a different story. And there you can get galloping gold. Now, last year we saw a 19% gain in gold prices pre-COVID, just based upon supply-demand fundamentals. This year we've seen a 28% in a very unusual conditions. Not a record year high, but close to it. It's not uncommon if you get inflation in the order of 4, 5, 6% for gold to gallop between 25 and 35% per annum. So if we do see significant inflation, then you can expect to see those sorts of gains. That's what history tells us, looking back to 1971. But at the moment, and again, we'll look to this Jackson Hole announcements from the US Federal Reserve, if they're going to ease up and allow increasing inflation over the next 2 or 3 years, and let's be honest, they need it to dissipate that massive debt burden that we have, then gold will be a beneficiary of that. If they keep a tight lid on inflation at 2%, then that won't be giving it quite the lift that we've seen. So we've had a good year. Gold typically trades in sort of 7 to 10 year bull runs. We've been in the doldrums for 7 or 8 years. Last year was a cracking year. This year's even better. History suggests we should have a 4 or 5 years of attractive bull run ahead of us. The difficulty is that we've just, in the last few weeks, gone rather parabolic. The so-called Robin Hooders, and there's been a degree of speculative froth in the market, which has taken it to the record all-time highs. That, to some extent, has been taken out of the market. I said it's been up at 2,075. Well, we're down to nearly 1,900 right now, just above 1,900. So there's been a bit of a clear out, and actually it's very constructive. If you want to have a decent, sustainable bull run, you need to have strong corrections. You can't go parabolic and maintain that for very long. So I regard this as a bull market correction. On the charts, it's forming what we call a pennant, a bull pennant, which is like higher lows and lower highs, forming a giant triangle. That's a very bullish construction, which normally, when it reaches to the end, means an up leg. When that will occur will be in the next 2 or 3 months. September is traditionally the top year of the year, seasonality-wise. So again, it may well occur in September that we see another spike higher. Again, depending upon what we hear from the Federal Reserve in the next couple of days, that'd be quite pivotal. So I remain bullish, but I get very nervous when everyone's universally bullish and thinks that the markets can remain in a parabolic state. It can't. If you want to know gold, then today you should look at silver to get the good indication of what gold's mood is. The moment gold's coming off, silver isn't. It's going, no, thank you. And actually, every now and then, silver does the talking for gold. And it's one of those moments in time when, for the best part of 2 years, silver's been perversely quiet. It's a very North American asset and phenomena, silver. We in the West don't invest in it quite so intensively. And then silver woke up, and then gold. You could see the absolute relief in gold. Thank you. We need you to confirm, authenticate the rally in gold. It did it because the gold-silver ratio went to 126, a 4,000-year high, ridiculously so, completely out of kilter. It's now back at 72, the gold-silver ratio, roughly where we should be in normal conditions. So that catch-up has occurred. I mentioned gold's up 28%. Well, silver's up 50% year to date. So a lot of that catch-up has occurred. But on an intraday basis, watch silver for what gold's going to do. At the moment, gold's coming off. Silver's quietly sitting there, sitting on a very important support level at $26.20, going, don't think so, gold. Come on, come back with me. So it's worth watching silver at the same time.
Okay, well, yeah, I want to come on to that, but I hear what you say from a sort of contrarian viewpoint. You don't want everyone to be pointing in the same direction, but my feeling is we are still so far away from the taxi driver telling you to buy gold. You know, we've got some of the biggest investors in the world coming into precious metals now, and we've got all the kind of retail investors still to follow them, surely, haven't we?
Yeah, well, we did see a spike of retail buying in March, back when you couldn't get it, of course, because of aircraft were grounded, trucks weren't moving. And so stores that had it sold out very, very rapidly. Just prior to March, if you looked on Google Trends, you'd have seen that the search term buy gold was at a 12-year low. And most mints were reporting gold sales at or near 12-year lows. So institutional buyers were buying, central banks were buying. The specs had pushed it higher, more recently have come off a little, but the retail sector still continues to be relatively lackluster, with the possible exception of the Robin Hooders. Again, they're very herd-like. You saw what they did to Kodak and to Hertz. There was some sense that they were getting in behind silver and helped lift it. I don't think taxi driver moment or shoe shine boy moment, I don't think we had it yet. We certainly saw it in 2011 when gold hit the previous all-time high at $1,922. And back then, it was cash for gold. Anyone who had any scrap jewelry was selling it. You know, clear out your old gold, darling, let's take it down the pawnbrokers. And that gold was melted down, went to Switzerland, cast into kilo bars, and was flown out to Asia. And it now sits with mature Chinese investors back in the 2000s, 2011. And absolutely everyone was doing it. And effectively, the West divested itself of its relatively small amounts of scrap that it had available. This time, Chinese and Indian demand is lackluster. Gold is trading at a small discount in China at the moment, a $10 discount. In India, it's a $30 discount, telling us domestic demand from the number one and number two buyer are very, very lackluster. But demand in the West, institutional, is extremely high. Family offices are buying. The smart money's in there, but it hasn't yet got the full momentum that we think is yet to come.
So it's interesting when you talk about the smart money, because really at a more kind of philosophical level, you know, people talk about gold as an investment, but in reality, obviously it pays no yield, as Mr. Buffett keeps telling us. So you're kind of relying on the price going up. But of course, really what's happening, gold isn't changing. The price is going up because the currency is coming down. So isn't it essentially a store of value and a hedge against inflation and currency devaluation?
The store of value is the key issue here. And, you know, fear factors, and COVID's one of them amongst any many, including the North Korea story. are never a really good reason for buying gold. We get bored of fear quite quickly. We get inured to it when we switch off. And the effect on gold is normally relatively short-lived. But look at the salary of a Roman centurion, how he was paid in solidus, silver and gold coins. It was equivalent to £43,000, exactly the same as a captain in the British Army today. So it demonstrates in one, if you like, that it has long-term purchasing power. Even in the Old Testament, which was never very well regarded for its accuracy, an ounce of gold would have bought you 350 loaves of bread. And again, if you consider the cost of a loaf of bread today, it roughly corresponds. So gold's not about getting rich. It's all about protecting your wealth. And it's very hard to see your wealth being dissolved. You and I remember when you're given £1 or a £10 note, you thought, great. Now £1 is shrapnel to wear a hole in your pocket of your trousers. You'd rather not have it. But one that, not so long ago, was worth something. Money dissolves quite inexorably. So Ronald Reagan called inflation the thief in the night, and that's what happens to your money in real terms. And if you want to see it writ large, and it's why we're seeing gold where it's at, and it's in the bond market. Nominally, again, you'll earn 70 basis points for investing in a 10-year US government bond, but after inflation, you're losing 1% per annum, and it's telling you something there. So inflation is key to gold as a long-term store of value.
Okay, and just I think, as I picked up from what you were saying before, you would see almost the allocation to gold as kind of an emotional decision based on your fear level of the stability of the financial system, and that would be how you decide whether it's 5, 10, 20% that you would allocate?
Well, I don't like to use the word fear or emotion, because I think any decision made emotionally is rarely the best one. I think you just have to think rationally. What are the chances of this all coming apart? It's said anyone who makes decisions emotionally is normally weak, because you can be pushed this way and that. I think a rational, sensible, hard look at the debt to GDP levels. Rogoff said any country that has got debt to GDP levels of over 77% will struggle to generate any level of growth. Well, in the West, we're well over 130%, and no country's ever come back from those sorts of levels to pay it down. Normally, they end in catastrophe. Rationally, you would think, I cannot see this being unwound in a happy fashion. I don't know when it's going to occur, but it's got to occur within the next 3 to 5 years, I would have thought. I don't know the precise timing. So you would think, I'll have an allocation. Do I buy the ETF? Do I buy the futures? Or do I buy the physical? I think typically the physical is better. There's a storage cost. The cost of putting it in a vault will be something in the order of £200 a year, but you can put £500,000 worth of gold in there. So, the sensible thing to do would be to do it. You talk about the emotional aspects of gold. To give you an anecdote, my uncle, he was an officer in the Italian Navy during the Second World War on an Italian cruiser. And I went to the Dolomites and I met with him. And he said, so what do you do? And I said, I work in gold. He smiled thinly. And my Italian's not so good. I said, do you know much about it? He says, don't talk to me about gold. He says, I know everything there is to know about gold. I didn't get back to home until 1948. It took him 3 years to get out of Russia, as it transpired, to get home. And at my weakest, worst moment, and I was with some other fellow officers, I had a gold chain and cross, and I was able to sell it to buy some food which sustained us for a few days. If you have to cross a boundary or a border, or in extremis, what are you going to take with you? A credit card, cash, or gold? Well, he knew the answer. There's only one thing you could bring, and that was gold. Mm-hmm. So for him, it was part of his DNA. He understood innately exactly what it was all about.
No, indeed, absolutely. Now, so as we compare gold and silver, and obviously silver is a much more kind of affordable entry into the precious metals world, though it also works in very much an industrial metal. If we were allocating, 100 units to metals, how would you see a split between gold and silver in that kind of allocation?
Yeah, we're moving towards making recommendations, which I do hate. Let me tell you what I do. I have an allocation to both, and I'm 2/3 gold, 1/3 silver. And that's quite high on the silver side. I do enjoy the speculative element because I watch the markets quite closely. I try not to trade in and out with news, which is quite hard. particularly with what's going on at the moment with Jackson Hole and gold coming off. It's tempting to take some profit at this point in time. But I'm currently 2/3 gold, 1/3 silver. My silver is an ETF because I don't want to pay VAT, and it's tight bid offer spreads. I'm sufficiently naughty that it's a 2-to-1 geared as well. I shouldn't be so geared, but I am. I enjoy a bit of speculation in there as well. I don't have any mining shares because I don't understand the sector well enough.
Okay. So as we come towards the end of our time together, Ross, I've got to pick your brains on the sort of young pretender to gold's throne, which is our friend Bitcoin. Now, often it's kind of described in similar ways with limited supply and so on, and more traceable. What's your take on the whole kind of crypto Bitcoin scene, and how would you compare it to gold?
Interesting that they're quite closely correlated at the moment. They're being seen as go-to safe havens. Okay, Bitcoin significantly outperforming gold and silver. I'm an admirer of the technology. I love the underpinnings and how it works and what it does. I understand what it's seeking to do. It's interesting how it's taken its blueprint from precious metals in terms of its structure, by limited circulation, if you like. And I think the best of both worlds is the combination of the two. Stable coins or gold-backed cryptocurrencies to lend some element of the tradition of aspects of gold and its 4,000-year history. Bitcoin, what's that got, 6 years behind it? It can't really ever claim to be a store of value, doesn't have enough history behind it to do so. But where it does have an advantage is over as a medium of exchange. It's getting better. Fiat currency still wins that game. Go to the pub, they'll take cash. But in an increasingly digital world where we're using touchless cards, and the ability to use cryptocurrencies as a medium of exchange, I think the bringing together of gold and crypto is a compelling story. It still hasn't garnered much momentum yet. I don't think there's enough sense of a need for it. I've never sold a gold bar where an investor said, what a shame it's not a token. They've always wanted the physical. But I think that the way this will evolve is the gold market is looking at having the background stuff, the boring bit, the settlement and the clearing of trades done on the blockchain. When that's done, then pushing that forward into a tradable asset, which is settled and cleared on the London bullion market at very good rates, etc., and tight bid offer spreads, is more doable. And the market's quite close to being able to trade professionally, the professional market, using digital assets, which is T+0. It's T+2 currently. Gold on the blockchain would be T+0, so have a massive cost saving to the market as well, reducing credit lines, etc. So I think in the next short few years, gold-backed tokens will gather momentum. The important thing is that it links into the real world, so that if you've got tokens, you should be able to redeem them for physical. Unlike the ETF, you should be able to take it down to your favorite store, a token, and redeem it for coins or bars as you require readily. Then that lends credibility to the token. We're not quite there yet, but that will come.
Okay, well, I think that touches on my final question, really, which is, obviously gold encourages, I think, long-term thinking, and given its history. So if we were having this chat in 2030, how do you imagine the world's kind of financial system will look in 10 years' time? And will some of these things you've talked about perhaps become mainstream by then?
In 10 years' time, I think that the need for banks will have largely gone. And I think that, let's say, for example, you wanted to pay me for this interview. You're smiling.
Very interesting thought.
You should be able to do so by a digital transfer to me, not to my bank, and I should be my own banker. And you should ask me, how would you like to be paid, sir? In British pounds, in gold, in potatoes, in whatever asset you would like. And you would have a range of assets you've got available. And it'll be peer-to-peer transfers of value, but not to my bank account. I would be my own bank. And I would be able to trade my various assets, which are, again, like foreign exchange rates, interchangeable. So you'd be your own bank, and I would probably hold mine as something that would be trusted, like a gold-backed token. And you can therefore transfer them to me seamlessly before the end of this interview even. Were you inclined to do so?
If only I had the technology, obviously I would use it right now, Ross, obviously. But Thank you very much. Some great advice and some great thoughts and insights there. Ross Norman, thank you very much for joining us.
Great pleasure. Thank you.